Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Valaris Limited annual report. Valaris Limited provides a range of offshore contract drilling services to various clients worldwide. The company operates in 6 key regions: Brazil, the UK, US, Gulf of Mexico, Australia, Angola, and internationally. Its services are categorized into 4 main segments: floaters, jackups, ARO, and other. The company's fleet consists of a diverse range of offshore drilling rigs, including drillships, dynamically positioned semi-submersible rigs, moored semi-submersible rigs, and jackup rigs. In addition to its own fleet, Valaris Limited also offers management services on rigs owned by third parties. This indicates that the company's scope extends beyond just operating its own equipment. Valaris Limited serves a broad client base, including international oil and gas companies, government-owned entities, and independent operators. The company's extensive global presence and diverse range of services make it a significant player in the offshore contract drilling industry. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The Valaris Limited stock price has seen significant growth over the past year, and several factors may be contributing to this trend. One possible reason is the company's strong financial performance, including increased revenue and profitability. This could be due to various business strategies implemented by management, such as cost-cutting measures or investments in new projects. Another factor that could be driving the stock price up is the growing demand for offshore drilling services. As global energy consumption continues to rise, companies like Valaris Limited are well-positioned to benefit from this trend. The company's expertise and equipment may be in high demand, leading to increased revenue and profitability. Additionally, changes in market sentiment or investor confidence could also contribute to the stock price increase. If investors become more optimistic about the oil and gas industry as a whole, they may be more likely to invest in companies like Valaris Limited, driving up the stock price. Lastly, mergers and acquisitions or other strategic partnerships may have played a role in the company's growth. If Valaris Limited has formed alliances with other major players in the industry, this could lead to increased revenue and market share, further boosting the stock price. Overall, it is likely that a combination of these factors has contributed to the significant increase in Valaris Ltd's stock price over the past year. Valaris Limited market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Valaris Limited holds a significant advantage in their industry. Valaris Limited trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 2.09 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance over a period of time. In terms of revenue growth, several factors contributed to this trend. The floaters segment experienced significant revenue growth in 2025, with a 48% increase from $823.4 million to $1,224.1 million. Additionally, reimbursable revenues increased by $108.2 million in 2023, while contract drilling expenses decreased by $812 million in the same year. On the other hand, revenue decline was primarily driven by the jackup segment, which experienced a 26% decline in revenue in 2023. Geographically, Brazil saw significant growth in revenue, with a 20.1% YoY growth from 2023 to 2024 and a 25.9% YoY growth from 2024 to 2025. In contrast, the United Kingdom experienced a decline in revenue, with a 42.2% YoY decline from 2023 to 2024. Other factors that impacted revenue include repair and maintenance expenses, which decreased by $236.2 million in 2025, and net gain/loss on sale of property, which had a positive impact on revenue in 2025. Overall, these drivers highlight the key factors influencing the company's revenue growth or decline across various segments, geographies, and customer concentrations. Net income and profit margins underwent significant changes between 2023 and 2025. Initially, net income decreased by $299 million from 2023 to 2024 due to various factors such as uncertainty in tax laws, increased competition, and cyclical nature of the industry. However, it rebounded strongly in 2025, increasing by $609.3 million compared to 2024. Profit margins also saw a notable improvement in 2025. The operating income margin rose from 14.9% in 2024 to 20.2% in 2025, while the net income margin increased from 15.7% to 41.5%. This significant increase can be attributed to various factors, including improved cost management and reduced expenses. However, despite these improvements, there were some areas of concern. The ARO segment saw a decrease in profit margins, dropping from 97% to 100%, while the total Valaris fleet experienced an increase in profit margins, rising from 61% to 65%. These changes highlight the complexities of the industry and the need for companies to adapt quickly to changing market conditions. The reasons behind these changes are multifaceted. Uncertainty in tax laws, increased competition, and cyclical nature of the industry all contributed to the fluctuations in net income and profit margins. Additionally, inflationary factors, cost escalation provisions, and reduced demand led to delayed cost reductions, further impacting the company's financial performance. The company's financial performance indicates a consistent trend of generating positive operating cash flow over the past 3 years. In 2025, the company achieved an operating cash flow of $546.2 million, followed by $355.4 million in 2024 and $267.5 million in 2023. These figures demonstrate a steady increase in operating cash flow, suggesting that the company's business operations are generating sufficient funds to cover its expenses and investments. This positive trend is a testament to the company's financial health and stability. The company's debt level has undergone significant changes over the past year. Initially, ARO's entry into a $359 million term loan led to an increase in its debt level, page 69. This trend continued as total liabilities rose from $1,349.3 million in 2024 to $1,402.8 million in 2025, page 95. Regarding interest expenses, the information provided is somewhat inconsistent. On one hand, pages 57 and 63 indicate a significant increase in interest expenses, with page 63 specifically stating that interest expense, net increased by $14 million, 17%, in 2025 compared to 2024. However, page 81 contradicts this by stating that interest expense, net decreased by $14 million from 2024 to 2025. Page 113 also notes an increase in interest cost in 2025 compared to 2024, but mentions it is similar to 2023 levels. In summary, the company's debt level has increased significantly, while the change in interest expenses is unclear due to conflicting information. Management is optimistic about the company's outlook, citing opportunities for continued shareholder value through sustainability efforts. The company has a long-term employment model aimed at fostering personal growth and engagement among employees. However, management also acknowledges several risks and uncertainties that could impact the business. These include potential delays or cancellations of the business combination, the highly competitive and cyclical nature of the offshore contract drilling industry, and the risk of losing significant customers or facing customer consolidation. In terms of liquidity and capital, management expects to fund short-term needs through cash flows from operations and may issue debt or equity securities in the future. The company is also reviewing potential acquisition opportunities, including acquiring rigs or other businesses. Industry trends suggest a need for sustained investment in oil and gas to support secure energy supply, with increased deepwater project sanctioning expected over the next 5 years. Management believes the company's fleet of seventh-generation drillships positions it well in the market. Despite these positives, management also highlights several challenges, including rising costs due to inflationary pressures and potential trade impacts, as well as regulatory risks associated with offshore drilling. The company has been actively involved in share buybacks as part of its strategy to return value to shareholders. In 2023, the company repurchased 3 million shares, followed by 2.2 million shares in 2024 and 2 million shares in 2025. This significant investment in buying back shares demonstrates the company's commitment to maximizing shareholder value. The share buyback program was authorized with a budget of up to $600 million, indicating the company's confidence in its financial position and ability to generate returns for investors. By repurchasing outstanding shares, the company is effectively reducing the number of shares available on the market, which can lead to an increase in the value of remaining shares. This move is a clear indication that the company is prioritizing shareholder wealth creation and is committed to delivering long-term value to its investors. Supply chain disruptions loom large in industry. The industry is facing significant concerns regarding supply chain disruptions. Key suppliers and counterparties are experiencing operational disruptions that affect the entire supply chain and logistics process. This issue is further exacerbated by supplier capacity constraints, production disruptions, and delays in delivering critical drilling equipment. Moreover, the consolidation of suppliers has led to a reduction in the number of available options for companies, making them more vulnerable to disruptions. The delivery of goods from third-party suppliers is also being disrupted, adding to the overall complexity of the issue. The situation is further complicated by the fact that 13 drillships are not working at year-end due to gaps between contracts and a lack of shipyard capacity for floater newbuild construction. This has resulted in significant delays and disruptions to operations, highlighting the need for companies to address these issues promptly. That concludes the financial summary for Valaris Limited. Feel free to comment below, and I will be happy to answer them when possible.